There's this ghost in the machine of the stock market. It's this strangely predictable surge that happens at the exact same time every single year, right around the holidays. People call it the Santa Claus Rally, but trust me, it has nothing to do with festive cheer. It's more like a structural glitch, and if you understand it, you uncover a fascinating and honestly kind of terrifying secret about how the markets really work.
Okay, so let's just look at the raw numbers here. For the last 70 plus years, during a very specific 7-day window between the end of December and the start of January, the S&P 500 has gone up 79% of the time. That is just an insane level of consistency in a world that's supposed to be completely random.
And we're not talking about tiny, insignificant gains either. The average return during this short little 7-day period is a positive 1.3%. Now, I know what you might be thinking. 1.3%? But in the market, context is everything. So to put that into perspective for you, the average gain for any other random 7-day stretch is just 0.2%. So we're not talking about a small quirk here. This is a massive anomaly. This makes the Santa Claus Rally nearly 400% more powerful than the market's normal day-to-day behavior. It's not some little seasonal thing. It's a huge, statistically significant event that really shouldn't happen in an efficient market. So what on earth is causing it? Now, the easy answer, right, the one everyone gives, is holiday optimism, people spending their bonuses, that kind of thing. But honestly, that's just a nice story. The real truth is way more, well, mechanical. This isn't about moods or feelings. It's about the very plumbing of the market temporarily breaking down. It is a glitch. And this, right here, is the crucial point. The real value, the thing that gives you an edge, isn't in knowing that the rally usually happens. The secret is understanding the dire warning the market is screaming when, for some reason, it doesn't happen. And yeah, we're going to get to that at the very end. So what's the first core reason for this glitch? Well, in late December, all the adults in the room, the big institutional players, they just vanish. Think about it. The big shot traders are on vacation, they're closing their books for the year, and as a result, trading volume just plummets. We're talking by up to 40% across the board. The whole market basically becomes an empty room. And this creates what's called a liquidity vacuum. It's a fancy term, but all it really means is that with fewer big players around, the market gets really thin. And that means even small buy orders, which would normally get swallowed up without a ripple, can suddenly have a huge impact, pushing prices up way more easily. So who's left driving the car? Well, it's temporarily handed over to two main groups: individual retail investors, who, let's be honest, are usually a bit more optimistic, and automated systems like your 401k contributions, just flowing in. There's simply no big institutional selling pressure to stand in their way. Let's move on to our second truth. And this one, well, it's a little more cynical. It's all about the games that fund managers play at the end of the year to make themselves look good. It's a little trick called window dressing. So here's the playbook. At the end of the year, fund managers have to send a report to all their clients showing what stocks they own. So to look like geniuses, they buy up all the year's big winners, the hot tech stocks, so they appear on the report. And at the same time, they quietly dump all their losing bets to hide the evidence. So what's the result? You literally have thousands of fund managers all buying the exact same popular big-name stocks at the exact same time. And since these are usually the biggest companies in the S&P 500, this coordinated, completely artificial buying helps lift the entire market. Now for our third truth, and this one might be the most important of all. The Santa Claus Rally often isn't about a big surge of new buying. It's more about a sudden, dramatic absence of selling. All through November and early December, there is this massive wave of selling pressure from something called tax loss harvesting. That's just investors selling their losing stocks for tax reasons. But here's the thing. That selling has a hard deadline. And by the middle of December, it just stops. So here's the whole point. Right when the Santa Claus Rally period is supposed to start, a massive source of downward pressure on the market just, poof, it's gone. The market isn't rocketing higher because of a flood of new money. It's just kind of drifting up in a vacuum because all the sellers went home. It's basically a relief rally. So let's recap. We have a market with almost no volume, some artificial buying from fund managers, and pretty much no sellers. The market is basically programmed to drift higher. And that brings us to the big payoff, the reason this all really matters. What happens when, despite all of that, the market still goes down? Just look at the data from the rare times Santa failed to show up. In 1999, the rally failed, it lost 4%, and boom, the dot-com crash followed. In 2007, it dropped 2.5%, boom, the global financial crisis followed. A failure here is an incredibly powerful bearish warning sign. And the logic here is actually really simple, but it's so powerful. If the market can't even manage to go up when all the conditions are perfectly set up in its favor, it means there is a deep, powerful underlying weakness. It means the big institutions are selling with so much force that they're overpowering all these natural tailwinds. The market is basically screaming a warning at you.
So that leaves us with the big question, right? Is this yearly pattern just a gift for traders to profit from? Or is it something else entirely?
You know, Yale Hirsch, the analyst who first documented this whole thing way back in 1972, he put it perfectly with this now famous line. See, the saying isn't about celebrating when the rally happens. It's about being terrified of its absence. He understood that the failure is the real story. And that's really the ultimate takeaway here. The Santa Claus Rally isn't just some quirky holiday tradition. It's a diagnostic tool for the health of the entire market. The real edge, the true secret, isn't found in blindly betting on the rally to happen. It's found in understanding the profound, ominous message the market sends when it doesn't.